Welcome to the CalPERS Review of Tobacco Investment Restrictions webinar. My name is Wiley Tollett, and I'm the Chief Operating Investment Officer in the Investment Office of CalPERS. In April of 2016, the Investment Committee directed that staff review the CalPERS restrictions on tobacco investment. The purpose of this webinar is to provide an overview of the current state of the tobacco investment restrictions at CalPERS and the investment concerns that led us to where we are today, and seek stakeholder input as we evaluate the continuing relevance of those concerns going forward. CalPERS is committed to transparency, and the Board of Administration wants to hear your thoughts as part of this review. Our goal in this webinar is to outline the issues that contribute to the complexity of this topic. We will explore CalPERS' prior actions related to tobacco divestment, general investment considerations, and some of the broader implications of divestment related to managing the investment portfolio. This topic is scheduled for the December 19, 2016 Investment Committee meeting in Sacramento, California. We encourage you to send your feedback by November 11th using the contact information you see on the screen, which will be repeated at the end of the webinar. The CalPERS mission is to provide responsible and efficient stewardship of the system to deliver promised benefits while promoting wellness and retirement security for our members and beneficiaries. This important topic is worth a few minutes of our time. It's important to note that our role as administrators of the health insurance program is distinct from our role as fiduciaries for the retirement portfolios. It's also tempting to compare ourselves to other institutional investors in terms of their investment priorities. Consider, for example, the Robert Wood Johnson Foundation. The RWJF's mission is to help Americans lead healthier lives and get the care they need. Reflecting that mission and their guiding principles, they recognize that as a private foundation, they are stewards of private resources that must be used in the public's interest. They have a long-standing investment policy not to invest in companies whose products may conflict with their health and healthcare mission. The RWJF has this freedom as they're investing the foundation's own money, and they can invest it based on their own values and mission to influence public opinion in support of the foundation's social goals. I'm also reminded of my private sector experience with an investment management firm advising clients with a wide range of value systems and investment priorities. In that context, the client's own priorities and values inform the investment strategy. But it would not have been appropriate for my firm, as an investment manager and fiduciary, to put its own social priorities ahead of the client's investment goals. CalPERS, similarly, is not investing for its own account. The board and staff have been entrusted with funds from the state of California, public agencies, and their employees for the sole purpose, on the retirement side of the house, of providing promised retirement benefits to our members. This primary mission is what guides our investment strategy at all times. Why is CalPERS reviewing its investment tobacco restrictions now, you might ask? As fiduciaries charged with the prudent investment of the portfolio, the board has a fiduciary duty to ensure that as market conditions shift, past decisions, including divestments, continue to make sense for the portfolio. The board therefore has a fiduciary duty to conduct a periodic review of all existing divestments. The essence of a fiduciary relationship is the confidence, reliance, and trust that one group reposes in another for aid, advice, or protection. This is a very high bar, and where CalPERS is concerned, requires staff and the board to maintain a laser-like focus on striking the right balance between risk and return. In fact, the CalPERS board members are explicitly charged by the California Constitution with prioritizing 3 objectives over all other concerns. Number 1, providing retirement benefits to participants and their beneficiaries. Number 2, minimizing employer contributions. And number 3, defraying the reasonable expenses of administering the system. I should say a few words about the important link between investment performance and employer contributions. There are just 2 levers available for controlling the size of our employer contributions: benefit levels and investment returns. Absent a reduction in benefits, the only available tool in our toolkit for minimizing employer contributions is to focus on investment returns. As of June 30, 2015, there were over 3,000 employers and over 1.8 million members participating in the CalPERS system. Contributions come from both employers and employees. CalPERS represents a promise to these members and beneficiaries, a commitment to pay promised retirement benefits not just today or tomorrow, but well into the future over a very long time horizon, sustainably and affordably for all concerned. And as you can see from our next slide, a large portion, or slightly over 2/3 of those payments, come from our investments. Yet, in the prior fiscal year, CalPERS paid out more in benefits than we took in contributions and investment income. As with all pension funds, as we mature, our benefit payment outflows increase. So today's analysis is taking place against the backdrop of increasing demands on investment returns to fund benefits. Now that we've reviewed the purpose of today's webinar and some of the considerations unique to CalPERS, let's discuss in more detail how CalPERS invests. To begin with, the California Constitution explicitly requires CalPERS to diversify investments, minimize the risk of loss, and maximize returns. For further guidance and clarity, CalPERS has developed and adopted a set of investment beliefs. These beliefs provide a basis for strategic management of the investment portfolio, inform organizational priorities, and ensure alignment between the board and our investment office staff. The investment beliefs are not a checklist to be applied to every decision. They are a guide for making decisions that often require balancing multiple interrelated decision factors. They provide context for CalPERS actions, reflect CalPERS values, and acknowledge CalPERS responsibility to sustain its ability to pay benefits for generations. Each investment belief also contains several sub-beliefs that are actionable statements providing insights as to how the investment beliefs will be implemented. Several of the CalPERS investment beliefs are directly relevant to today's topic. For example, Investment Belief 3 states CalPERS investment decisions may reflect wider stakeholder views provided they're consistent with its fiduciary duty. This belief acknowledges that CalPERS, as a public agency, has many stakeholders who express opinions on investment strategy or ask CalPERS to engage on an issue. At the same time, this belief reinforces the fact that in the case of conflict, our fiduciary duties must take precedence. Investment Belief 7 states that CalPERS will take risk only where we have a strong belief we will be rewarded for it. CalPERS Investment Belief 9 states that risk is multifaceted and not fully captured through measures such as volatility or tracking error. As the largest public defined benefit pension fund in the U.S., CalPERS is, of necessity, a market investor, in the sense that prudent investment of $300 billion requires broad exposure to the entire market, as well as to a variety of different asset types. We select various benchmarks based on a wide variety of assumptions and paradigms, all of which require constant revisiting to take market movements into account. We take active risk when we believe we are being compensated by higher returns and/or lower volatility, all on the basis of our judgment of current market conditions and relative valuations. Such active bets against our benchmark require constant reevaluation as market conditions dictate. For portfolios using an index tracking strategy, we attempt to replicate a market index to generate a similar rate of return. This so-called passive approach to investing has been demonstrated to produce superior performance over the long term in efficient markets, such as the U.S. large-cap stock market. Our overall public equities portfolio has a low level of active risk, less than 50 basis points of tracking error. Divestment of any variety, on the other hand, ties our hands by excluding a given security from the CalPERS investment opportunity set, without the flexibility to reevaluate and reinvest as market conditions warrant. In this important respect, therefore, divestment runs counter to both our active and passive management strategies. CalPERS experience to date has shown that almost invariably, divestment harms investment performance. As I'll cover in more detail next, the 2001 tobacco divestment, though intended to mitigate risk to the portfolio, ultimately proved to be no exception to the general rule that divestment comes at the expense of investment performance. So in light of the foregoing, you might ask, why did CalPERS divest? In October 2000, after months of discussion, the board's investment committee directed staff to divest from tobacco-related securities for its internally managed portfolios, and to implement tobacco-free benchmarks for its public equity and debt portfolios. External active investment managers were not required to divest tobacco stocks. However, they were required to accept tobacco-free benchmarks. Returning to our prior question, why did CalPERS take action? At the time, it appeared that the tobacco industry might collapse under the weight of an ongoing barrage of litigation and regulatory actions, presenting ongoing financial risk to the fund. In addition, several other institutions, including state and county pension funds, were known to have implemented divestment or tobacco restrictions. Most other institutional investors, however, were slow to follow suit, and the legal and regulatory pressures did not, in fact, cause the industry to collapse. In fact, in terms of stock performance, over the past 15 years, the tobacco industry has been the second highest performing industry, returning over 900% in cumulative returns and significantly outperforming the broad market. An analysis performed in 2015 by Wilshire Associates, the board's primary pension consultant, indicated that the portfolio's tobacco restrictions had reduced portfolio returns by roughly $2 to $3 billion. The future is uncertain, and past performance is, of course, no guarantee of future results. From a purely investment perspective, focusing on risk and return, tobacco-related securities present several positive characteristics, including strong performance, high dividend yield, durability in down markets, and consistent cash flows. At the same time, there is reason to be cautious. Increasing long-term pressures may significantly strain the tobacco industry. These long-term pressures include falling tobacco sales volume in developed and some emerging markets as the number of people smoking and their individual consumption rates decline, pressures caused by ongoing litigation, and increasing regulatory pressures around the world, such as increased taxation, additive bans, restrictions on marketing, and disclosure requirements. As a long-term investor, CalPERS must consider risk factors that, while emerging slowly over long time periods, could have a material impact on company or portfolio returns. At the same time, consistent with Investment Belief 7, we take risk only where we believe we will be compensated by higher returns and/or lower volatility. There are, of course, material, social, and human costs associated with smoking behavior. An estimated 40,000 adults die each year in California from smoking-related diseases. And anti-smoking advocates argue that tobacco divestment decisions by institutional investors such as CalPERS contribute to the denormalization of the tobacco industry over the long term. On the other hand, we've yet to see evidence of any direct causal link between CalPERS divestment decisions and the rate of tobacco consumption in California or elsewhere. And while the social cost of tobacco is undeniable, it would not appear that the CalPERS tobacco divestment has had any discernible impact on the industry's market capitalization, access to capital markets, or financial performance. CalPERS is currently engaging subject matter experts, and we're looking to examine this issue in a balanced way this December. The board has several options available for their consideration in December. First, to affirm existing policy and maintain the status quo. Second, to extend divestment to externally managed portfolios. Or third, to remove the tobacco restrictions. Divestment, as an active investment decision, represents a form of active risk that must be considered first and foremost within the context of the board's fiduciary duty. In efficient markets, limiting the opportunity set for investments is expected to have a detrimental effect on performance over the long term. Our existing divestment policy and investment beliefs reinforce that divestment is not CalPERS' preferred approach. CalPERS, as a mature, cash flow negative system, must thoughtfully consider the assets and portfolio construction methods that best serve our mission, the sustainable delivery of promised benefits. On the other hand, the negative health effects of tobacco are well researched and documented. And, like many investments, the future outlook for the tobacco industry is unclear. The issues associated with managing the portfolio, policy and fiduciary requirements, and the current tobacco restrictions require careful consideration. Periodic, objective review of CalPERS divestments, including tobacco, supports the board's fiduciary duty and is consistent with our investment beliefs. We understand this is a sensitive topic, and we are interested in exploring this topic from all sides. CalPERS is engaging with subject matter experts from the asset management and public health communities in preparation for the Investment Committee's review in December. Your input is very important. We invite you to share your feedback by November 11th through email or letters at the contact information provided. Thank you for joining us today, and have a great day.